All right, third hour of the program. We'll continue a thread here from the end of the last show. We're talking about money and Warren Buffett at the end of the last show. But we'll start off this hour by talking about your money and the capital gains tax hike. Now, in the last federal budget, the government announced they would be increasing the capital gains inclusion rate from 50% to 66.7%, two-thirds, for those who earn past a $230,000 threshold. Following the announcement, the Quebec government, Éric Girard, followed suit and increased the province's inclusion rate to match the federal levels. This applies, of course, to capital gains after June 25th. Now, a new study from the Montreal Economic Institute shows that raising the capital gains tax could deter capital investment and entrepreneurship in this country. Let's now go to Emmanuelle Faubert, who authored the study for the MEI. Emmanuelle, welcome back to the program.
Thank you for having me.
So let's talk, first things first, right? I think when people hear about the capital gains tax and the increases that were made, I think for a lot of people, they say, oh, it's not going to apply to me. It doesn't bother me. And the federal government keeps touting this line. I forget what the number is, 0.013%, something like that, right? So let's tackle it first things first. For our listeners, who does this really affect?
Well, it affects everyone, whether it is directly or indirectly, because it's not just investors. There's a lot of people, let's say, you have doctors that have their own practice, you have entrepreneurs that have their own little shop, mom and pop shop, you have restaurants, you have a lot of people that had invested in a duplex or a lake house. These people have invested a lot of money into one venture. They've invested all of that, and these people, once they sell, they will be taxed for the capital gains they're making because on their return of investment. And a lot of these people, that's going to happen once in their lifetime. So basically, we're taxing retirement funds. So that's one side. And the other side is that with investment and innovation and entrepreneurship, we raise the quality of life of Canadians. So if we disincentivize entrepreneurship, everybody will be affected through the lack of innovation.
Do you buy the number the federal government says about people who are directly affected? Do you buy that it's so low?
Not really, because as I said, there's a lot of people that will have a plex, that will have a little restaurant, that normally do not make $250,000, but will once in their lifetime, once they decide to retire. So there's a lot of people that will be taxed once and will probably reach over that $250,000. So it's more than what they're expecting.
And that's it, right? I think the government figure is about, well, in this specific year, it's going to affect that small percentage. But over someone's lifetime, much likelier that you'll be affected by it, right? Because it's not every year that you'll have a gain like this.
Exactly.
Okay, now let's talk about the indirect stuff. How does this increase in the inclusion rate, how does that lead to less entrepreneurship?
So let's also talk about the fact that, first of all, income tax, it has already gone through. So that money has already been taxed. So what happens is then if people invest, for example, you have venture capital market, where a lot of startups require such investments in order before they are able to go public. So these people, venture capitalists, they invest and they also provide guidance. So if they're taxed more on their return on investment, they're going to be less likely to invest in startups and also provide less guidance. So considering that 9% of startups fail as a basis, if you provide less guidance and less funds, there's even more risks of failing. And it's these startups that not only are important for productivity and for economic growth, but also they're important to maintain our quality of life. Otherwise, we're going to have a gap compared to other countries.
The federal government, I've heard Chrystia Freeland and the Prime Minister say this word ad nauseum, fairness. This is about fairness. This is about fairness. What do you say to that? That actually a measure like this is just going to lead to a fairer society?
It's not really fair when you consider all these people that are going to be taxed once in their lifetime because we're taxing their retirement fund. So this is not fair. And it's not fair to penalize local investment in startups. If you think about it, the government is raising taxes for us, for investors in Canada, but at the same time, they're spending billions of dollars to try to attract EV batteries manufacturers in the country. So they're saying it's fair, but at the same time, they're taking our money and sending it to specific industry that they believe will be beneficial for Canada. But studies have shown that in reality, it's not subsidies that will provide economic growth. It's entrepreneurship and what we do ourselves if you leave the money in the pocket of Canadians. So there's nothing fair about penalizing local entrepreneurship, but then also having subsidies of billions of dollars to international multi-corporation.
We're with Emmanuelle Faubert from the Montreal Economic Institute. Emmanuelle, I was listening to a fund manager talking about the recent decisions by the federal government, and they were concerned, they were worried that moves like this will lead to people that can decide, oh, should I start a business in the U.S. or in Canada? It'll lead them to go south of the border, and that in turn would lead to the Canadian dollar falling significantly in value. What do you think? That it's not just this one measure, by the way, tons of measures from the federal government. Do you have a worry, a long-term concern about this measure and others leading to a scenario where the Canadian dollar is devalued and less businesses set up shop here?
Definitely. If we're looking at non-residential private investment per worker, which is a measure of productivity, of how much investment we have in our country. In Canada, last year we were talking about 17,389 per worker. In the U.S., it was at 27,307. So we're talking a gap of $10,000 per worker. Mm-hmm. And if we're disincentivizing investment in Canada, that gap is just going to continue to grow. And if that gap is not closed, we're just gonna be late compared to every country, the other countries of the G7.
What do you say to someone that looks at the situation with deficits and debt and says, well, government needs to raise money somehow, might as well do it this way? What do you say to someone who says that?
The problem is not a revenue problem, it's a spending problem. So the government should reduce the spending, for example, reduce the subsidies for the EV battery sector, and instead leave the money in pockets of Canadians to invest more, which will be good for economic growth, and then we'll have more revenues for the government. And if they reduce their spending and we have more economic growth, that deficit will be better dealt with than if they take more money out of the pockets of Canadians, like they're doing right now.
We're going to have to leave it there, Emmanuelle. It's always a pleasure talking to you. Thank you so much.
Likewise. Thank you.
That's Emmanuelle Faubert, who authored a recent study on the new capital gains hike for the Montreal Economic Institute.